Hello friends, how are you all? Let us continue international economics. In the previous video, we have started the topic of foreign investments. Okay, and we have already seen about the FDI in the previous video. In this video, we will discuss about the foreign portfolio investments. Okay, so first of all, let us understand what is the meaning of portfolio first. Okay, let me erase this. See, portfolio basically means that, say there is an individual and he has some 50,000 rupees. Okay, he wants to invest it in stocks he wants to invest it in stock market. So this particular individual will not put all his 50,000 rupees into stock of one company. Okay, so say for example, if he puts his money all in one company, say Reliance, and tomorrow if something bad happens to Reliance company, so all his money will go down the drain. So usually whenever any investor invests, what he does is he will invest his money into many different companies, into many different kinds of instruments. For example, he will invest 5,000 rupees in Reliance. He will invest another 5,000 rupees in another company, say Amazon. Then he will invest say 5,000 rupees in gold. He will invest 5,000 rupees in FD. So this is how he will save. Like he will put small portion of money out of his total savings into different kind of instruments or different companies. At least if he wants to put all his money into shares, he will at least put it into different companies. Okay, maybe 5 companies, 10 companies, like that. So this process is known as diversification. What he is doing, he is diversifying his risk. This is known as diversification process. And when a person is doing diversification process, he is actually creating his portfolio. So this is his portfolio. So all the companies in which he is investing become a part of his portfolio. Okay, so that is known as portfolio investment. When you are creating your own portfolio to diversify the risk, obviously somebody will invest with a hope to get some returns, right? With the hope to get some interest, with the hope to get some returns in the future. So people will create portfolio by diversifying the risk. So foreign portfolio investments basically are the investments by the people or the companies or the institutions, okay, which are investing in order to make their portfolio, in order to diversify their portfolio. And such investments are allowed under the portfolio investment scheme of RBI. Okay, so there is a portfolio investment scheme under which the foreign portfolio investors can apply, can buy stocks or equity or even debt instruments in our Indian companies. So foreign portfolio investments, FPI, basically now you understood the broad meaning of FPI. It is done in order to diversify the portfolio. So it can either be done by the institutional investors. So when FPI is done by the institutional investors, it is known as foreign institutional investments, okay, including their sub accounts. I'll explain it to you what is the meaning of this. Then it can be either by the qualified foreign investors, okay, another kind of people, another set of group who can invest under the foreign portfolio investment schemes. And then there can be NRI investments also. Okay, NRI meaning non-resident Indians. They can also invest through the portfolio investment scheme. Now let us look at them one by one. So what is foreign institutional investment? Institutional here means that they are registered as foreign institutions. Okay, institutions meaning they have to be registered as either some company or a trust, okay, or anything, or they have to be registered as an institution in a foreign country. So they are the foreign institutions who want to invest in India, and such institution they have to register with SEBI that we are the institutional investors. Okay, so see, there are two types of registration here. One registration is that they're registering in their home country that we are a investment company or we are a trust or something, anything, it can be anything. They are registered people in their individual countries, and that is how they become institutions. And now these foreign institutions, now they are investing in India. That's why they have to register with SEBI also, that we are the FIIs, we are the foreign institutional investors. Okay, and they can invest directly in India. Okay, they can directly invest in India after getting registered with SEBI. So foreign institutional investors includes investment companies, okay, insurance funds. So maybe there is an American insurance funds, they have an insurance company. Now whatever premium money they are collecting, obviously they will invest it into their portfolio. right? They are also investing. That is how they are doing the insurance business. So they can invest in India, they can invest in foreign countries. So insurance funds are also considered to be institutions. It can also be some individuals, right? Institutions can also be some high net worth individuals also. Okay, and example of this investment companies, foreign institutional investments, is HSBC, okay, Hong Kong and Shanghai Banking Corporation, then Citigroup, Merrill Lynch, etc. These are some of the names which you may have come across in the newspapers. Okay, so these are the example of investment companies. They are the foreign institutional investors. Okay, now let us look at this. Let us move forward. So foreign institutional investors, they can invest in shares, okay, shares meaning equity, or they can invest in debt instruments also. See, in FDI they could only invest in equity or fully and mandatorily convertible debentures, preference shares, share warrants, that was allowed. Basically everything related to equity, ultimately it has to be equity. But foreign institutional investors under the portfolio investment scheme, they can invest in debt instruments also, like bonds, debentures, etc. This is under the portfolio investment scheme. Now see, there are some rules here. So basically a foreign institutional investor under the portfolio investment scheme, they can buy maximum 10% stock of any one company. For example, there is a foreign institutional investor called HSBC. So HSBC can buy maximum 10% of shares of any one Indian company, say Reliance. So HSBC as a foreign institutional investor can buy maximum 10% of shares of Reliance company, okay, of any one company. And in any one given company, maximum shareholding by the foreign institutional investors and NRIs combined can be 24%. For example, say Reliance company. So Reliance company has, say, a total market capitalization, total share in the market of, say, 100 million. Okay, 100 million total share value it is there. Now there are so many FIIs in the world. So all the FIIs combined and all the NRI investment combined in that Reliance can be maximum 24 million. Okay, it can be maximum 24% of everybody combined, and any one foreign institutional investor can invest maximum 10% in one Indian company. Okay, so you just try to understand this. See, because if it becomes more than 10%, it will be counted as FDI. Okay, if it becomes more than 10%, then it is no longer FPI. It is no longer foreign portfolio investment. It will become foreign direct investment. And in order to invest in as a foreign direct investment, there is another scheme called FDI scheme. Okay, this is not under portfolio scheme. So under portfolio scheme, maximum 10% is allowed for one institution for one company. Okay. And in debt instrument, they can actually invest any amount. Okay, there is no cap of 10%. They can also invest, in one company. For example, there is a company called Reliance, and Reliance company has issued some bonds. Okay, some bonds, and now anyone, say HSBC, can purchase 100% of these bonds. Okay, so there is no bar on that. So this is a very important difference. Now here this 24% limit by all the FIIs and NRIs combined, it can be raised to the sectoral cap after approval by the general body of the company. So for example, if the general body of Reliance company, it decides that we want more foreign institutional investors, more than 24%, that is more than this 24 million, then their general body has to approve it. Also the RBI will approve it, and then it can be raised up to the sectoral cap. Sectoral cap meaning, for example, if this Reliance company is in the sector of petroleum, so if the petroleum department, Ministry of Petroleum, they have a sectoral cap of, say, 49%. Okay, this is just an example. A maximum foreign investment in petroleum sector is 49%. So this 24% can maximum become 49% after the general body approves it. Okay, so that is the rule. Now these rules keep on changing, friends. This is a rule as of December 2022. I am telling you, this rule can change in future also. So you have to just keep yourself updated with the current affairs. Now the FIIs, foreign institutional investors, can also invest as FDI, as I have already mentioned to you, if they happen to purchase and hold more than 10% equity in a listed Indian company or any amount of equity in unlisted company. But for this, companies have to issue shares under FDI scheme. Okay, under portfolio investment scheme, these shares cannot be issued. Okay, so these companies have to issue these shares to the foreign institutional investors under the FDI scheme. Now see, this is very important because see, I had already told to you in the previous video that foreign institutional investments under certain circumstances, under certain situations, conditions can also be FDI. Now when can they be FDI? I have explained here. They can be FDI when they are holding more than 10% equity in listed company or any amount of equity in unlisted company, and they have purchased this through the FDI scheme. Okay, they have purchased this through the FDI scheme. But friends, foreign institutional investors are generally not interested in doing FDI. Okay, they are not interested in buying the controlling share in any one particular company. So they are usually not getting into this FDI scheme. They are usually going through the portfolio investment scheme only, because they are there to make money. Okay, they are not there to do the business. FDI main purpose is to do business, to run a business, to do controlling of a business. But FII people main intention is to earn money from the stocks, to earn money from the share market. So that is their main purpose. So usually they don't go into that, but it is allowed. It is possible that FII can be FDI. Okay. Now let us move forward. If foreign individuals want to invest in India, they get registered as a sub accounts of FIIs. Okay, so with SEBI, they get so they are not so for example, they are not the institutions themselves. Individuals are not registered as institutions. So but if they want to invest as FIIs, they have to open a sub account with SEBI. Okay, they have to register themselves as sub accounts of a particular FII, and that is how they can invest directly in the shares or bonds in the market. And how it happens? So FIIs on their behalf will buy the shares and bonds. Okay, जिसके साथ में भी उनका registration हुआ होगा as a sub account, they will buy. For example, if there is one individual, say high net worth individual, say for example Bill Gates. Okay, so Bill Gates is an American person. He resides in America. So Bill Gates will get registered as sub account of say Merrill Lynch. Okay, Merrill Lynch. Now Merrill Lynch will invest in the portfolio investment scheme on behalf of Bill Gates and buy shares and bonds and will allocate those to Bill Gates accounts. So that is how it is done. And as of now, only high net worth individuals, meaning individuals who have the minimum net worth of $50 million can register as sub account. So this is a condition of RBI. So only people जिनके पास में $50 million से ज़्यादा की दौलत है, नेटवर्थ है. नेटवर्थ का मतलब होता है उनके एसेट्स माइनस लायबिलिटीज. ओके, नेटवर्थ मीन्स एसेट माइनस लायबिलिटी. सो दे हैव सम प्रॉपर्टी, दे हैव सम मनी, दे हैव एसेट्स, दे हैव गोल्ड, दे हैव ज्वेलरी, दे हैव लैंड एटसेट्रा, एंड दे ऑल्सो हैव सम लोन्स, दे मे हैव सम लायबिलिटीज. सो व्हेन यू सब्ट्रैक्ट लायबिलिटीज फ्रॉम एसेट्स, दैट इज नोन एज द नेट वर्थ ऑफ दैट इंडिविजुअल. So that net worth should be more than $50 million. So they can invest. Now let us move forward. So FII bring in hot money. Okay, see, I have told you FIIs usually invest, foreign institutional investors invest in Indian markets, or for that matter any markets, because they have some money they want to invest, they want to make money, they want to earn profit, they want to do capital gains. Okay, जैसे for example today they will purchase Reliance shares for 500 rupees, and maybe say after 1 week it becomes 510 rupees. So they get 10 rupees profit for one share in 1 week. They will get this 10 rupees 1 week and they will sell their shares, and they will take that 10 rupees and also this 500 rupees out. Okay, so and they are mostly speculative in nature. Speculative meaning they do it with a hope that prices will increase in future. All right, because they are diversifying their portfolio, they also want to make profit. So they are speculative in nature, and it is a hot money. Okay, hot money meaning they are unstable, they are volatile, they can pull out money overnight. रातों रात पैसा बाहर निकाल सकते हैं वो लोग इकोनॉमी से. So that is why it is unstable, it is hot money, and it is not as stable as FDI. Now as of now there is another rule of RBI which says that for any one foreign institutional investor, the equity to debt portfolio should be 70:30. So if their investment is 100 rupees, so out of 100 rupees 70 rupees should be invested in equities and 30 rupees should be invested in debt. So that is how the normal portfolio should be of a given foreign institutional investors. In this 70, it can be multiple companies. Okay, it can be 10 companies, 20 companies, 50 companies, and debt also it can be many companies. But the ratio, the monetary ratio should be 70:30. They can also invest 100% in debt also, right? But they have to register as 100% debt fund with SEBI. So they need a separate registration for that. That okay, we are 100% debt funds, and we will invest only in debt instruments, that is bonds and debentures. So they can do that, but they have to register separately. Now let us move ahead. Let us move to another concept which is known as qualified foreign investment. Again, qualified foreign investment is invested under the portfolio investment scheme, FPI. Okay, so it was introduced in India in 2011 for foreign individuals who want to invest in India without sub account of FII. Okay, so if there are some individuals, if they are they want to invest without getting registered with SEBI as FIIs, as sub accounts of FIIs, they can also invest, and it was introduced in 2011. Okay, and this step was taken by Indian government to attract the foreign investment in our country. Now what they have to do, they have to simply open a demat account or a trade account with the depository participant. Now see, this depository participant meaning the participant in the demat system. Okay, just try to remember, demat system में हमने depository participant देखी थी, right? For example, ICICI Bank, SBI Bank, these are the depository participants. Who are the depository participants of CDSL or NSDL, right? So they are the depository participants. So they have to, just like our Indian people, we open a demat account and do trading. They can also a demat account and do trading by opening a demat account in depository participants like ICICI, SBI, HDFC, etc. Okay, and these are the participants in demat system and not the depository banks, as in the case of ADR and GDR. Don't get confused. Okay, this is not the depository banks of the investment banks which issue the ADR and GDR in the American and European markets. Okay, it is not that. This is the depository participants of the demat system. Please try to understand. So don't get confused here. Also, this investment is different from investment in P notes, participatory notes. In participatory notes, these people, they will not open any account in the Indian bank, they will not have any demat account, they will not do any KYC compliances, nothing. They are completely unknown to the Indians, to the Indian government, to the Indian regulations. But so that is how they can invest in P notes, okay, participatory notes. In this case, there is a investment bank, they will purchase shares and they will issue participatory notes to the foreign people, to the non-resident people. That is a different way of investing. But here the qualified foreign investment in this, although they are not registered with SEBI as a sub account of FII, but they are registered with the banks. So they have done their KYC compliance and etc. Okay, so some detail we have, ki who are these people, who is investing, where are they from, etc. Now, qualified foreign investors can be individuals, it can be groups, or it can be associations also. Okay, QFI should be resident in a foreign country which is compliant with standards of FATF. FATF is Financial Action Task Force. We will learn this later on when we will study the international bodies. Okay, so basically the country has to be compliant with the standards of FATF, and that country should be a signatory of International Organization of Security Commission. So see, Securities Commissions meaning just like our SEBI. So India's Security Commission is SEBI, America's Securities Commission is SEC, Securities and Exchange Commission, like that. So every country has a body called SEBI which regulates the financial markets. So there is an international organization of all these securities commissions, okay, of many countries, and this body, this International Organization of Securities Commission, they have signed a MOU, Memorandum of Understanding. It is known as Multilateral Memorandum of Understanding. Multilateral because it is between many countries, multiple countries. Okay, between many countries, multiple countries, that's why it is known as multilateral. So generally MOU are bilateral, right? Bilateral meaning between two countries. Multilateral meaning many countries. So it is an MOU signed between many countries. That's why it is known as multilateral MOU. And this multilateral MOU is of the International Organization of Securities Commission. So only countries which are part of this IOSC and who have signed this MMOU, resident of those countries only can be registered as QFI, are qualified as QFIs. Okay, and QFIs can invest in equity, they can invest in bonds, they can invest in government securities, they can also invest in treasury bills, they can also invest in commercial papers. So see, treasury bills and commercial papers are part of money market. Please revise this. Okay, short-term instruments. Then Indian mutual funds also. Okay, so they can invest in all these instruments. Now again remember, we have already seen that any type of foreign investment was not allowed in chit funds or nidhi companies, not allowed in agricultural plantation activities, real estate business, meaning sale and purchase of real estate, trading in transferable development rights. So FII is also not permitted, right? Another thing, FII's foreign institutional investment is also not permitted to invest in the equity of asset reconstruction companies, ARCs. Okay, what are ARCs? We will study this again in detail when we look at the economic reforms. But for now, just try to remember that ARCs are a company which kind of buys the non-performing assets of bank. Okay, and then they try to reconstruct these assets of the bad assets of bank, and that is how they help banks in recovering their bad loans or their NPA loans. So they are the asset reconstruction companies. We will understand them in more detail later on, but keep one thing in mind, that in equity of these ARCs, FIIs are not permitted to invest. So this was about FIIs. We will learn about NRI investment in the next video. Thank you.